are the tax implications on investments made in India by NRIs? What are the income tax provisions related to NRI investments? Keep watching this video to find out the answer to these questions and understand the investment opportunities for NRI in India and their tax treatment. Hi everyone, I'm Maheshti from Clear. We have assisted more than 80,000 tax experts and 6 million tax filers. Do subscribe to our channel to support us and get a clear explanation of taxation and finance concepts. After ensuring PAN and eKYC, NRIs can easily invest in the Indian capital markets. They can invest in equity shares, mutual funds, national pension schemes, etc. Apart from this, they can invest in the real estate sector and fixed deposits linked to NRE, NRO or FCNR accounts. But it's important to know the tax implications of such investments. So without any further delay, let's jump into the tax treatment of different types of NRI investments in India. The tax liability on capital gains on sale of listed equity shares or redemption of units of equity-oriented mutual funds is categorized into long-term and short-term capital gains. If the investment in equity shares or equity mutual funds is held for less than 12 months, then the capital gains are considered short-term capital gains. Such short-term capital gains are taxed at 15% and subject to TDS at the same rates. Otherwise, investments held for more than 12 months shall be treated as long-term capital gains and taxed at 10% on long-term capital gains above Rs 1 lakh. Also, TDS will be deducted at 10% from such long-term capital gains. Now coming to taxation of capital gains on redemption of units of debt mutual funds by NRI. If the investment in debt mutual funds is held for less than 36 months, it will be considered short-term capital gain and subject to tax at normal tax slab rates. However, TDS on short-term capital gains on debt mutual funds will be deducted at 30%. If the investments are held for more than 36 months, they will be considered long-term capital gain and taxed at 20% and so is the TDS. The capital gains on investments made in unlisted shares will be considered short-term if they are held for less than 2 years and will be taxed at normal income tax slab rates. However, TDS on short-term capital gains on unlisted shares will be deducted at the highest slab rate at 30%. If the unlisted shares are sold after 2 years, they will be considered long-term capital gains and taxed at 20% with indexation benefits. Interest earned on fixed deposits from the NRO account is taxable. The deposits in the NRO account may include income from rent, dividends, pension, interest, etc. received in India. The interest earned will be subject to TDS at 30%. There is no threshold limit for a tax deduction. For instance, TDS is deductible if the interest on fixed deposits of residential Indians exceeds Rs 40,000 during the year. No such limit applies to NRIs for interest earned on fixed deposits from the NRO account. However, income earned from fixed deposits or savings from NRE accounts is tax-free. Also, interest from an investment in FCNR deposits is exempt from tax. The TDS is deductible only on income taxable in India. Hence, no TDS will be deducted on interest earned from NRE and FCNR accounts as they are tax-free. Where NRI purchases any property from the resident of India, the NRI is required to deduct TDS at 1% on the payments to be made to the seller of the property, provided the purchase amount is Rs 50 lakh or more. If the NRI sells property in India, tax must be paid at 20% for long-term capital gains, that is property held by NRI for more than 2 years. And for short-term capital gains, that is for property held by NRI for less than 2 years, tax should be paid at normal tax slab rates. However, the buyer of the property is required to deduct TDS at 20% plus cess and applicable surcharge for LTCG if there is a long-term capital gain. Otherwise, the NRI should deduct TDS at 30% plus cess and applicable surcharge for STCG for short-term capital gains on the sale of property. NRIs can take advantage of the DTAA. Where the Indian government has an agreement with the country of the taxpayers, that is NRI's residents, the NRI can pay taxes as per the agreement. They can pay tax in both the countries and claim tax relief from the country of the residence or pay tax in either of the countries as cited in the DTAA agreement. I hope this video was helpful for you. For queries related to taxation or finance, you can contact our experts by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more such informative videos and stay tuned for more updates.